I've seen a lot in my 15 years on the trading desk, but I've never seen this. Gold at 4 grand, oil and stocks completely imploding, and this has the echoes of every major crisis from the last 50 years, all at once. What we are seeing today, October 11th, 2025, is a moment of truth for the global financial system. Gold at $4,000 isn't the cause of this crisis, it's the symptom, it's the fever. The disease is a system drowning in debt, where the very plumbing of global liquidity has just been shattered. In the next 8 minutes, we're going to break down exactly what is happening and, more importantly, why. We'll answer 3 key questions. First, where did all the liquidity go and why did it vanish overnight? Second, how the new tariffs and China's moves in the gold market connect this chaos? And third, why is the Federal Reserve now trapped in the most impossible position it faced since 2008? Let's get straight into it. If you want to understand the deep market mechanics behind these moves, make sure you're subscribed with notifications on. We break this down every week. The market is in a state of shock. As I'm recording this, the S&P 500 is down double digits, oil has tumbled, signaling a complete collapse in demand expectations, and the US index or the DXY is spiking violently. Normally, that would mean gold gets crushed. Instead, it's exploding higher through $4,000. When the dollar and gold both scream higher, it signals something far more dangerous, a crisis of confidence in all paper assets. It's a global margin call where the only acceptable collateral is becoming physical metal and the world's reserve currency. This was triggered, of course, by the announcement of sweeping new tariffs on Chinese goods, but the tariffs weren't the cause. They were just the pin that hit that everything bubble. So, what is the real cause? It has to do with the financial plumbing, the system that moves money around the world. And that system just broke. Now, to understand what's really going on, you have to look at this through the right lens. For decades, the world has operated on a simple deal. The US buys goods from countries like China and we pay them with dollars we print. They in turn take those dollars and buy our debt, US Treasury bonds. This props up our bond market and keeps our interest rates low, is the exorbitant privilege. But what we're seeing now is the end of that deal. China has been slowly but surely dumping US debt, and with their newly introduced gold warrants on the Shanghai Gold Exchange, they created an escape hatch. So they've built a direct pipeline to trade goods like oil from the Saudis for physical gold, completely bypassing the US dollar. The tariffs are simply the US retaliating against this move, trying to reassert dominance. But it's too late. The de-dollarization train has left the station. So why did this geopolitical chess move cause markets to freeze up? Because it triggered a panic in the system's plumbing. Think of global liquidity like the water pressure in a skyscraper. The Federal Reserve controls the main pump. Things like the reserve repo market and the Treasury's bank account, the TGI, are like giant water towers that can store or release pressure. When Trump announced tariffs, it was a geopolitical shock that caused a sudden, desperate scramble for US dollars. Every corporation with dollar-denominated debt, every foreign government needed dollars right now. And this created a massive vacuum, sucking liquidity out of every other asset. Stocks, bonds, oil, everything was sold to get cash. It's the dollar wrecking ball effect we've talked about before. So, the dollar or the DXY spikes, but in a way that breaks the system. The pipes have run dry. And this leads us to the Federal Reserve. They are now well and truly trapped. This is their 1931 moment, their words of finance endgame. So they have option 1, which is they can raise interest rates to defend the dollar and try to attract foreign capital back. But look at the US national debt, over $37 trillion. So even a small rate hike would increase the US budget with interest payments. It would be political and economic suicide. Also, they can do what they always do, and this is to print money. But look at your screen, gold is at $4,000. Printing money now to solve a debt problem is like drinking seawater to quench your thirst. The market is screaming that it no longer trusts the quality of the currency. And if they turn on the printers now with QE, they risk hyperinflation and a complete collapse of the dollar's credibility. So, quick question for you. Which path do you think the Fed will be forced to take? Higher rates or more QE? Let me know below. Now, to be intellectually honest, we have to red team this argument. So the mainstream view would say that this isn't a collapse of the dollar but a flight to the dollar. And they would argue that the DXY is spiking for a reason. In a crisis, the US is still the safest house in a bad neighborhood. They'll say this is just a severe but temporary panic caused by tariffs. They'll point to official inflation data, the CPI, and say it's under control, so the Federal Reserve has room to maneuver. From this perspective, the smart move is to buy the dip in stocks because the Fed will eventually be forced to provide more liquidity, calm the markets, and everything will go back to normal. While I respect that view, it ignores the elephant in the room. The reason the house looks safe is because it's the one with the fire hose, but the foundations of that house are cracking under a mountain of debt. What's happening isn't new, it's a pattern as old as money itself. It's the 1930s with beggar, the neighbor, tariffs, and a global debt crisis. It's the early 1970s when the link between the dollar and gold was severed because the US couldn't afford its promises. In both cases, the monetary system broke and had to be reset. We're in the late stages of a long-term sovereign debt cycle. That's the core thesis here. And the events we are seeing, like gold repricing, the weaponization of trade, the breakdown in the bond market, are not random noise. So they are the logical conclusion of decades of accumulated promises that can no longer be kept. The system isn't just correcting, it is changing, and the price of every asset on earth will have to change with it. This is a rapidly evolving situation. If you just got value from this breakdown, hit that like button and subscribe for our next video where we will discuss the specific assets that can weather this storm. Thanks for watching.